Good afternoon, members, friends, and all those who are participating in the webinar today. As you are aware, from the platform of Indian Banks Association, we have been arranging webinars on various relevant topics for the benefit of our members. In this series, now today we have benefit of presence of leadership executives from ASIFMA, that is Asia Securities Industry and Financial Markets Association, which is an independent regional trade association comprising a diverse range of over 165 leading financial institutions from both the buy and sell side. So we have representation from ASIFMA. We have speakers with us today. Some of them are on the screen, while we have some representatives here also. Among the speakers, we'll have Ajay Sehikonda, Catherine Wartman, Arman, and then Matthew Chan. We also welcome Dinah, Head of Public Policy and Sustainable Finance, ASIFMA, and other dignitaries from ASIFMA and the speakers. And at the same time, we also welcome all the participants from various banks. We have some bankers present in person with us in the conference room, but most of them are on the screen, logged in virtually. So welcome to all of you to this webinar. Today's we'll be focusing on transition finance primarily. To take this program forward, I will now request Diana to take it forth. Over to you. You can, or you would like to give introduction of the speakers, or how to go ahead.
Sure. Thank you so much, Mr. Gupta, and thank you for the Indian Banking Association for this great opportunity to cooperate. We really hope that this is going to be a successful example of how we can work together and how we can share knowledge, because I think the purpose of this meeting is really to discuss things and to share the knowledge from our members to your members and vice versa. I think in the interest of time, because we have a lot to cover, I'll probably not go through the bios of the speakers because you've already seen them there in the program. I regret to say that one of the speakers, Aaron Joshi, had to drop from today because he had a family emergency. His father is not very well, and he apologizes deeply, but he won't be able to deliver his presentation. So I'll probably start myself setting the scene a little bit with what transition finance is and how we understand it from a kind of global financial sector perspective. And then I'll hand over to my colleague Matthew Chan from JP Morgan to talk about their experience in the transition finance journey, followed by Ajay, who is here with us, who can add a little bit of the Indian flavor of this whole story. And then we'll transition to talk about taxonomies and disclosure and data, which will be covered by Armen and by Catherine. So we have very intense 2 hours. I really hope that they will be useful and informative, and please feel free to ask questions as we go. I understand there is a chat box where you can post questions for those of you who are online, but feel free to use any means to interrupt the speakers and ask your questions. So that's on the logistics. And again, thank you very much for the opportunity. So transition finance has become lately probably the topic when it comes to sustainable finance. And a lot has been said in the past few years about green, what is green, how we're going to reach these targets. All the countries, most of the big companies, most of the financial institutions have made their commitments to net zero by certain times and certain kind of interim targets that they've set up to themselves. Now the big question is how we're going to go there, how we're going to reach this. And although Europe started with a very kind of strong start with delivering a lot of regulations when it comes to green finance, they had perhaps the most comprehensive taxonomy, the green taxonomy, which is being used by pretty much most of the stakeholders to develop their own taxonomies. In terms of transition, Europe and the rest of the world actually do not have so much to offer right now. So it's Asia, which is a little bit ahead of the game with certain, and I'll not go into the details because my colleagues will be able to talk about it, but transition taxonomies in ASEAN, Singapore is incorporating transition activities in their taxonomy. Other jurisdictions, Japan is looking at transition by actually taking a different approach, not having a taxonomy, but developing sector plans, which are transition sector plans. So making sure that the sectors have their individual pathways versus having a universal framework that you apply to all of them. So all this is very exciting. And of course, Asia has some particular, very kind of pronounced transition challenges. And one of them is coal and use of coal. And this is another topic which we just started discussing, how we're going to transition out of coal. And one thing to be said about Asia is that on average, the age of a coal power plant is 13, 14 years. And coal power plants have 34, 40 to 50 years life expectancy. So when you have already invested in a fixed asset, which is with this duration and which is so young, it's very difficult to actually divest and move your investment elsewhere. So this is going to require a huge amount of thinking and adjusting everything really. So again, we have seen some of the Asian countries already trying to experiment in this, with Singapore recently issuing a paper with McKinsey on phasing out coal and how carbon credits can be used to co-finance these projects. There are other attempts by GFIT, the Asian branch of GFIT, and other economies as well. So maybe I stop here because the topic is really huge and there's a lot of theoretical kind of thinking around it. And I think we did provide a list of useful reading for those of you that want to look at the theory. But really the benefit of this session is to hear from the practitioners, from the multinationals, how they approach this, given that a lot of them, well, most of them actually talking now are headquartered elsewhere. So they have to comply with the regulations and requirements and expectations from their headquarters, but they also operate in different places in Asia, including India. So how you join all these dots to actually comply with your general strategy, but also satisfy the needs of the different markets that you're serving. And on that note, I will just stop myself here. And unless somebody wants to post any questions, I'll just hand over to Matthew Chan from JP Morgan, who would be able to bring the case study of JP Morgan and how they're looking at transition and sustainable finance. Over to you, Matthew.
Thanks, Diana, and appreciate the opportunity to speak to everyone. I'm just going to see if I can share my screen, so bear with me. And if not, I might need someone else to share the slides, which I think is the case. I'm not sure how to share them on WebEx. Is that possible?
Yes.
Yep. Okay. I'll let someone else handle the slides. Maybe just while we're sorting that out, just to give a little bit of an introduction, I am Matthew Chan, so I lead the sustainability function for JP Morgan across Asia Pacific. And that entails everything from kind of the strategy that we set globally. Yes, they're the ones. If you want to, yep, great, thank you. Brilliant. Yeah, so in terms of corporate strategy, the way we think about these things, we set the sustainability strategy and agenda for the firm, obviously taking into account stakeholders. We think about ESG and climate reporting, and also work with regulatory and policy advocacy. So what I wanted to do today was just to provide, I suppose, as a bit of a general overview, some sense of how we manage climate transition and how we manage our climate targets and commitments and put them into practice. So it's very much from an international perspective. So we're a US bank, but we're obviously working across different markets. So if we move to the next slide, I think there's a disclaimer. So if you have your magnifying glasses out, the bottom line is just to let you know that obviously what I'm about to share is publicly available, but also if there are any opinions that I'm sharing, they're really just my personal opinions in terms of market trends and so on. So moving to slide 3, great, the agenda. I'm going to provide a little bit of an overview in terms of how JP Morgan looks at environmental sustainability, how that fits into kind of, our strategy, why we do these things, what does that mean in terms of, how we think about environmental sustainability, and then we'll drill down a little bit more into a little bit more granularity in terms of what does that mean for climate, what kinds of targets have we set, and then how do we assess different transactions and think about that, and then how do we meet our commitments over time. We'll do a little bit of, as part of that, talking about carbon compass, which is the way that we think about our carbon emission targets across the different portfolios that we think are most carbon emitting. And then I'll spend a little bit of time talking about methane abatement, not too much time, but just as an example of how that could fit into the framework. And then I'll share with you some resources. I'll also share some thoughts, if helpful, around how that all fits into kind of the taxonomy discussion. So moving to the next slide, thank you. Our approach to environmental sustainability is on this slide. But basically, to put it all into context, we are thinking, our view as a large US bank, one that's operational in many economies around the world, we think it's incumbent on the financial sector to play a role in supporting and helping address the most pressing environmental and social challenges of our time. And so what do we bring to bear? That's lending and investment capital. It's also our philanthropic capital. It's our policy expertise. It's our data insights and analysis. And then, of course, our skills and talent for people. So we really do think of this through a strategy lens. What do we bring to the problem, and how can we help solve the problem? And so you can see a quote there from Jamie Dimon. So obviously there's a top-down kind of approach to this. Getting a little bit more granular, the way we think about environmental sustainability is laid out at the bottom half of that first slide. We think about scaling green solutions. So this is where we think about, renewable energy. What role can we play in terms of scaling those sectors up, etc.? How do we help the market generate solutions, whether it's climate or what have you? The second piece is around meeting our needs responsibly. And so that's where a lot of our targets and commitments come into play, and also how we measure that and how we think about each transaction and what that means for each of the targets. And then I'll touch a little bit on the third pillar, which is minimizing our operational impact, but I won't spend too much time on that. And then the final piece, which is the orange piece along the bottom, is kind of, the bedrock on which that all sits. And that's about accountability. It's also about, how we interact with our shareholders, our stakeholders, etc. If we move to the next slide, I'm now going to unpack some of the 3 pillars. So we've started very broad level strategy. We've then talked about environmental sustainability and how we think about that. I'm now going to go into each of the pillars. When we talk about scaling green solutions, we think about that in kind of 3 different ways. One is the fact that we have a role to play in terms of mobilizing capital for climate action. So as you can see, that's about developing solutions, working with clients. How do we advance the transition to a low carbon economy? Require capital. So that could be anything from when we're a lead underwriter, that could be, issuing a green bond for the Nature Conservancy, for example. That could also be where we're helping with IPOs. And that could also be where we're raising sustainability bonds, for example. So that's bringing capital. The second one is about how do we provide sustainable solutions to consumers and investors. So again, we're across different type business activities. And so that would cover our asset management division as well as our private bank. So providing solutions where investors and clients can invest into sustainability related sustainable investments. And then the third piece, which interacts with the first one, which is supporting our clients. So we have many obviously existing clients. So how do we support them? So that could be anything from green economy banking. That could be the Centre for Carbon Transition, which sectors, and we work with them around their transition plans, which is how we hope to meet our sustainability and climate objectives. And then we offer other things like ESG solutions, etc. If we move to the next slide, this is really where we start to talk about our targets. So I'm now moving into the second pillar of our environmental sustainability strategy, and that's how do we meet our these needs in a responsible manner. So what we did was we set decarbonisation targets. As I mentioned at the very outset, we have exposure to many different sectors across the global economy and within markets, including this part of the world. And then we, in 2021, identified the 3 top carbon emitting sectors, and then we set targets. We set 2030 targets, and these are aligned with a trajectory for 2050 to be net zero. We have an exposure to oil and gas, and so there you can see that we've selected 2 different targets: 35% reduction in carbon intensity in terms of operational carbon, and then 15% reduction in terms of end-use carbon intensity. So these are not absolute targets; these are intensity carbon measures. The second target that we set was around electric power. So again, you can see 69% reduction by 2030. And then we also set one around auto manufacturing. And so that's a 40% reduction. In 2022, we set further targets. So this also points to the fact that this is obviously evolving. Well, 2 things really. One, that we're targeting those sectors that are most carbon intensive, but then 2, this is continuing to evolve and we continue to add targets. So around this time last year, we added 3 more targets, bringing it to a total of 6. And there you can see that we've got commitments to reduce carbon intensity across our portfolio for iron and steel by 31%, cement by 29%, and aviation by 36%. If we move to the next slide, this is more about how we minimize our operational impact. I won't go into too much detail, but this is thinking about our own transition. So regulators around the region and internationally are obviously interested in both our financing, but also how we're reducing our own footprint. Long story short, the left-hand side is really about our carbon footprint. So we're offsetting, but more importantly, we're also reducing the actual amount of scope 1 and scope 2 greenhouse gas emissions by 40%. We're also sourcing renewable energy for 100% of our global power needs. And then within that, we're also trying to do that on site to, again, increase efficiency and reduce carbon intensity. And then you can see some other targets, which I won't go into today. And then that was the 3 pillars. And then the final piece, which sits along the bottom, is around what I mentioned before: accountability, transparency, and engagement. So obviously as well, it's very important, obviously, to set targets, but then we think a very big part of this challenge is obviously to be accountable for the commitments that you're making and very transparent about how you're doing that. So we do have our climate report that we produce annually. We also have our ESG report. We also engage with our stakeholders, whether they're shareholders, but also NGOs and other stakeholders. And then we also engage very openly and publicly, very openly with the policy and regulatory community, as well as broader industry engagement. So that's the very high level structure that we think about climate transition. I'm going to get a little bit deeper in terms of just spending a little bit of time in terms of what we call the carbon compass. So as part of being transparent, and if we move a couple of slides down to, we can probably go to slide 7, the carbon compass. What you can see there is, it's a timeline talking about how we've, been on a journey, as Diana put it, in terms of our climate management and strategy. But what I wanted to highlight was the fact that we do have the carbon assessment framework and also the carbon compass. So the carbon compass is really our way of thinking about how do we turn those commitments into real targets that we're using on a day-to-day business as usual basis, to then assess how we're going against the commitments by each sector, and then as each new transaction comes on board. I also want to hasten to add that all of this is publicly available. So if you, for example, and I will share some links soon, but if you if you could just Google JP Morgan Carbon Compass, and part of our transparency is to show our methodology, because we want people to understand how we're measuring these things, and so that is available. So briefly, Carbon Compass, the next slide, slide 8. A few principles that it's based on. One, it's science-based, so we think about different trajectories, we think about what's possible and what's not. We measure these things and we track these things on a sector-specific basis. So you'll recall, obviously, we had 6 different targets and we were adding to those, but they're sector-specific. The measures and metrics for each of those sectors are different. They're all carbon intensity, but the carbon intensity might be measured in slightly different ways. It could be, per unit of power output, or based on revenue from a particular industry. 3, decision useful. So we're thinking about, well, how do we make sure that these metrics can actually aid us in making decisions? And then we base it on the best available data, which obviously continues to evolve. And then in terms of the methodology, 1, we've defined sector activities, emissions, and financing and scope. So they're the 6 sectors that we're continually adding to. Then we've developed decision useful emissions metrics. And you can see a formula on the right-hand side, but really, as we look across a portfolio, we will have a metric in terms of how that portfolio within that sector is performing in terms of carbon intensity. And that's, if you like, a weighted average across that portfolio globally. What that enables us to do is have some flexibility. So it means that we can make choices in terms of some markets are different. So Diana, of course, mentioned, Asia, emerging markets might have different constraints or different trajectories versus, say, Europe. And so there is some technical flexibility at the moment in terms of measuring these things at the portfolio level to allow for some accommodation of differences by region. And then, of course, we determine appropriate emissions trajectories for each sector. And then we derived from that our 2030 targets that lead us to 2050 net zero commitments by then. And then, of course, we reassess that. In terms of how we think about measure our financing, so the denominator in the measure, obviously it's around our cumulative financing, and that could be, credit, so cumulative credit that we've provided, or also could be our share of facilitation in terms of debt capital markets and equity capital markets. And so we use this framework to assess, but also to govern our trajectory and how we're performing against that. And also we report against that in terms of our climate report. So a couple of words on methane abatement on slide 9. So this is an example where we put it into action. So obviously that can look like working with clients, asking them what their transition plans are, getting ourselves comfortable that they do have a transition plan, that those transition plans are credible. And then in terms of our advisory services, methane abatement is one example where we could work with a client around, well, say they are in oil and gas. And, obviously there are going to be options to slowly move the energy mix or the revenue mix for that particular company, if they're a power company, to renewables. So we might do that through IPOs, through providing advice to them. But also we work within the oil and gas sector. And so that could be actually thinking about, well, how within the oil and gas sector can we reduce the carbon intensity? So methane is one example where significant reductions can be had. And that's based on the fact that methane, for example, has 25 times the intensity of carbon in terms of heating in the atmosphere. And in oil and gas, through flaring, through leakage, there's a lot of methane leakage. And so there is an opportunity to work with our clients around how do you measure that, how do you put detecting equipment in, and then how do you reduce emissions. So that's one example where in a current high emitting, hard to abate sector, we can work with clients to bring down their emissions. So I'm getting close to the end of my presentation. It's been very high level. I just wanted to say a couple of words in terms of taxonomy, because what we have is what we would call a carbon assessment framework. Well, there's 2 things. The carbon assessment framework is how we measure each client and each transaction and determine whether we can take that transaction on and what that would mean in terms of our own trajectory and our own commitments in terms of carbon intensity reductions within a sector. That would be based, a carbon assessment framework would be done on a transaction, and that would be based on both qualitative and quantitative information. Quantitative information might include their historic CO2 emissions. It might also include things such as what plans they have, and then also what they're forecasting in terms of carbon intensity. The qualitative would be around what commitments they've made publicly to reduce their carbon emissions. Do they have a transition plan? That's how we would assess a transaction. So in a way, that's kind of how we think about that's how we would think about a transaction. And in some ways, that's the taxonomy that we use internally to think about, when we should finance something and when we should be comfortable moving forward with working with a client or transaction with comfort that that's going to conform to our commitments and standards. The second piece I'll say is that we also have a 1 trillion green target, which is to finance and facilitate green solutions in the order of $1 trillion over 10 years. So that's another target that we've set, which is more, I suppose, bottom up. And then we have a whole other rule book that we use internally across all markets, but it's global, where we set what we would include as or count as green. And so I guess the bottom line in terms of taxonomy and how we think about these things, obviously that second piece is informed somewhat by the different taxonomies that are developed globally. But as an international bank, it's very important for us to be able to have a global framework that we can use. And so both the carbon assessment framework, which is how we measure transactions against our commitments on climate, as well as the criteria that we use when we're deciding when to include a transaction into our green target, for example, they're all driven by internal rules and criteria that we've generated. So I might stop there, and hopefully that was a good overview in terms of how an international bank that's headquartered in the US would think about transition and work with clients and the frameworks that we've adopted. And happy to take questions either now or at the end. Thank you. Oh, I can't hear any sound in case people are talking to me.
Thank you, Matthew. Yeah, sorry.
Yeah, thank you. Thank you very much, Matthew. I think we have some questions in the chat box here.
They just asked to share the presentation, please, after the session.
Okay, we'll share the presentation subsequently.
Yes, that's okay with us.
So, Matthew, may I ask a question then and play the devil advocate? One of the key things in the way that you're approaching transition is setting not net targets, but intensity targets. So what drove this decision? And I see this across all of the sectors that you're addressing at first stage. And also, what would be the progression in terms of reviewing your transition plans, including new sectors or expanding on the targets that you have, how you're going to continue this?
Yep, two great questions, and we get asked the first one a lot by shareholders and stakeholders. So we, as Diana points out, and as I mentioned, we do have carbon intensity targets as opposed to absolute carbon emissions. For us, that really reflects the idea that, our job is, we think that that's more decision useful. So we think that how we can serve climate or support the industry and support clients in terms of their transition is to work with them. And so that by having a carbon intensity target, we can measure the carbon intensity of one client and compare it to another client, and we can decide whether one's more intense than the other, and so whether there's more opportunity to bring down the carbon intensity. It also speaks to the fact that we don't think it's useful in the broader scheme of things to just walk away from clients because they have a higher carbon emissions. And so by having absolute targets, there's a danger that you're basically incenting the financial institution just to walk away from the more carbon intensive clients. And so by having a measure that actually looks at, well, how much do they produce and then how intense is that carbon, there's more opportunity to work with them to kind of intensity that they generate per unit of output or revenue, depending on what the metric is. That said, we obviously, I mentioned about accountability. So one thing that we are going to do going forward, and we've announced, is that we're going to have absolute emissions reporting. So while our targets will still remain for the moment based on carbon intensity, because we think that's the right path, we also recognise that some people want to see absolute carbon emissions from a financing point of portfolio financing point of view, and so we are looking to provide that in coming months or years. In terms of new sectors, in fact, I think it's sooner than that. In fact, in terms of new sectors, obviously, I mean, we're guided by which sectors we have exposure to and which sectors we think are the most carbon intensive. And so we started out with the 3, we added the 3 to bring it to 6. At this very moment, we're looking at a number of new sectors. And so hopefully within coming months, we may be able to share which new sectors will add to the 6 targets that we have already. And that's obviously, we go through that process, which is outlined on one of the slides, which is, we look at it, we identify a sector because it's carbon intensive, and then we think about, well, what's the right trajectory that we should be thinking about? How does that align with net zero by 2050? What do we think is feasible in terms of that sector, and then set targets accordingly.
Matthew, can you read the chat box? There is a question there.
Sorry, let me see. It's been a while since I've used WebEx.
So can we read for you? Yeah, can you read?
the question?
Yeah, please read. Read the question.
I cannot see from here, sorry.
Surely. Mukti, you can read that.
Yeah. Okay, the question is, what are challenges in renewable energy and IRA procurement for operational carbon neutrality?
So one by one, you can read. So this is the first question, Matthew.
That's the only question.
Sorry, what was the question?
Okay, I repeat, what are challenges in renewable energy and IRA procurement for operational carbon neutrality?
Was the question, what is the challenge around
What are
achieving-
the challenges in the renewable energy and IREC procurement for operational carbon neutrality? I don't know what
It is the
IEC.
Rural Electrification Corporation.
Oh, okay, sorry.
It's an agency. It's a India specific.
Okay, would you spell it out and explain, because I don't know this term yet.
I'm not familiar with IRC either.
Yeah, but I think I'll just step in if I understood the question correctly. If you're procuring renewable energy, what is the impact on operational carbon neutrality? The thing is, as any institution would be starting to procure renewable energy to reduce their own emissions, especially the scope 2 electricity emissions, that will have an immediate impact in terms of achieving your carbon neutral goals. And if you see, most of the institutions have actually set out their scope 1 and scope 2 related carbon neutrality. People have not fully dwelled into scope 3 carbon neutrality, because that is dependent on your entire value chain per se. So in that lens, it will have a direct positive impact for you to achieve a carbon neutrality from your own operations per se. And that is one of the most prime factors we are seeing by companies as well as banks for their own carbon neutrality. I'm not sure of the IREC procurement point, but happy to get further clarification on that.
I'm happy to say a couple of comments on how we approach carbon offsetting and carbon neutrality for our own operations. I mean, it is on one of the slides, we do lay it out. So we spend a lot of time thinking about our carbon offsetting And so we have a very significant program in terms of purchasing carbon offsets. And in fact, we have a white paper, and I'll be happy to share the link to that. It's called, I think it's called the Carbon Market Principles. And that's really laying out the need from our perspective to develop carbon markets generally, obviously for a benefit for the broader economy, and also putting a price on carbon and incentives, but also in terms of raising the standard and confidence in carbon markets. The second thing that that paper does is also lay out the principles. So there's about 8 or so different principles that we follow in terms of how we think about the carbon offsets that we purchase. Obviously things like additionality, do we have confidence in terms of the types of projects? It also lays out the kinds of projects we would pursue. So for example, is it removal? Is it by technical means, for example, through carbon capture technologies, or is it through forestry? There's the challenges with either. So obviously technical challenges, the technical carbon removal is more expensive, but then many of those solutions are more permanent versus forestry, for example. So I'd be happy to share that paper with folks as well.
Thank you, Matthew. So I think we have one more question there.
Okay. So Matthew, the next question is, are you able to incentivize clients in hard to abate sectors towards transition?
So we do often get questions from clients, and depending on what services, there may well be incentives. So for example, different, for payments, there might be different incentives, etc. However, I think for the large part, a lot of it is actually just working with them and recognizing that they need to think for their own strategic purposes. They need to think about climate and climate change and how they're responding to that. So for a large part, in terms of how we work with clients, it's not necessary with us holding incentives to say, well, if you do this, you're going to get deeper funding.
Again. Yeah, Matthews, I think there is one more question.
Okay, there is a last question here. How do you model the pricing to factor in climate risk?
I'm not quite sure what does that mean, pricing in climate risk, or?
Yes, that's the question, Matthew.
Sure. So in terms of climate risk management, the way we manage that through our general risk management function. So we think about climate, what that impact that has, whether that's transition risk, whether that's physical risk, and then we translate that into kind of the normal pillars in terms of credit risk, etc. And that gets managed by our climate risk function. And then we have a centre of excellence which sits in the UK, for example, and they are looking at climate risk. And then we have people and risk management professionals in the different markets. And then we're monitoring climate risk through them. I suppose in some ways that's separate in terms of what I'm talking about, which is like, how do we work with our clients to manage transition? And I think sometimes that gets conflated. So I think it's actually a very important point to make, which is all I've discussed is seen by us through the lens of strategic planning. It's a strategic business activity where we're thinking about the external and commercial environment, the economy is changing, what are the changes that our clients need to make? And we're thinking very long term, obviously 2030, 2040, 2050. Sometimes from a climate risk perspective, we're thinking about different and sometimes shorter time horizons. And so for us, they're two very important but separate kinds of lenses to look at climate change. One is about the opportunity and risks from a strategy point of view when we're working with clients. And then the other piece is kind of how we look at that in terms of what is the shorter term impact in terms of through the standard risk management lens that we would apply.
Matthew, can we take the next question?
So the question, I think, is IREC, International Renewable Energy Certificates used where renewable energy supply is not available. Oh no, so I think someone's just defining something there.
Yeah, I think there was.
Okay, so I'm taking the next question. Have IPCC factored in current and potential geopolitical conflicts like Russia, Ukrainian and Israel war for generating GHG and global warming for net zero by 2050?
So that's a big question. When we think about, I suppose it goes back to my point before, which is we think about these things through a strategy lens. And even, in fact, if you go, if you were to look at the slides, you'll see even the quote from Jamie Dimon actually has him talking about a balance that we're trying to strike. I can't remember the exact words, but basically we think about these things in a broader context. And so whilst we think we have a role to play in supporting our clients around climate, we also temper that with the idea and the notion that, you know, it's not in isolation. And so, for example, there's a balance that needs to be struck between climate and the transition, an energy transition that needs to happen on one side. And on the other side, we also need to think about energy security. And so we're very engaged in terms of policy discussions and discussions with our clients and other stakeholders about the fact that we have to solve these things together. They're not mutually exclusive. I think in this part of the region, there's obviously other factors. Many on this call would be familiar with emerging markets where you're actually potentially managing a number of different competing priorities. One is climate, another is energy security, a third one might be economic development and in turn energy affordability. And so I think that's a great question. And it leads us to, I suppose it points us to the idea that we need to think about climate within a broader context. And so we're often trying to solve for more than one thing at the same time.
Matthew, there are two parts to this next question. So I'm taking the first part. Are your carbon intensity targets based on amount lent or revenue earned?
I think they vary on the different sectors. So if people were to look at the Carbon Compass methodology, they could get a more granular picture of what each of the metrics are. But it's a combination.
Okay. Secondly, in order to meet upcoming disclosure requirements, that is ISSB, CSRD, SEC rules, are you also measuring absolute carbon emissions, which are perhaps the starting point to calculate intensity?
So we will be publishing absolute carbon emissions in the future. Yes. So that means we are measuring them.
Great. Thank you. Thank you very much, Matthew. And it was a good discussion. And I hope you are continuing with us and there will be some more questions and we'll come back to you. Meanwhile, I think I will request the next speaker now. Mr. Ajay Shivkonda from EY. Yeah, Ajay, over to you.
Thank you. The last one. So while the slides come up, Matthew, are you able to hear me clearly? Is my voice coming up clearly? Just wanted to take
sorry, yes. Are you talking to me? Yes.
Yeah, it was efficiently.
Okay. No, the next one. The India Transition Finance. The last one, yeah. There's only a couple of slides. I just wanted to keep it more interactive with this group. So while the topic came up in terms of transition finance, and especially from an India perspective, I'll just take a step back and just give a bit of a background in terms of what's happening in India, just so that we are all on the same page. From an overall sustainable financing and climate financing perspective, a lot has been picked up from a renewable energy and the segments which is well understood. And recently, when after the sovereign government bonds have been issued, there has been this green financing framework which has come from RBI, which has a specific emphasis on specific set of activities. However, that is still a definition of green finance, which is about how you are creating projects which don't have any impact on climate. But there's a very, very large segment which is a transition finance, which is left out by it, which is where most of the large corporates, mid corporates in India would need financing for to decarbonize their own operations. Now, after the entire BRSR related guidance which has come from SEBI, most of the all the top 1,000 listed companies have gone into a pathway where they are quantifying their own emissions, they are going through their ESG strategies and putting together the decarbonization roadmap. So that's a regulatory driver which is giving you transition financing demand. The second is obviously a lot of the Indian corporates are part of the global supply chains, and given the kind of demand they are hearing from their buyers and suppliers, that's another area where there's a significant demand coming up for them to decarbonize. And third is obviously the inevitable, because in certain sectors, like for example, auto, EVs are picking up. We have 2030, let's say India has a target of 30% of electric vehicles by 2030. That itself has a significant impact. If they don't transition, then some of these businesses can become obsolete. So all of these drivers is putting a significant demand for transition finance. It is not sustainable, it is not green finance, it is not social finance, pure financing which is needed for corporates to manage their decarbonization roadmap. And that's not so much of work which has been done in terms of the supply side of it. Now, just to put things into context, in terms of what is the demand for this kind of financing, and that's something we just picked up certain statistics which is published by ministries and RBI. Overall, given the kind of decarbonization commitment, the Panchamrut commitments which India has given, we would need at least $7 trillion by 2050 to decarbonize our key sectors. So it's $7 trillion. We're still not an economy which is more than 3 trillion, just to put things into perspective, right? Secondly, if you want to accelerate a lot of these things, there's another 5 trillion which is needed. Let's not talk about acceleration because we're still thinking 2070. Let's keep the 7 trillion picture in the mind, which means in the next 10 years, on an average, every year we need 170 billion invested for transition finance. And when I say transition finance, a pure play viability gap funding which is needed for a lot of these projects. Right now, what is the supply? Around 44 billion. These numbers are slightly 1 year old, but maybe ballpark, I don't think much has changed from a transition finance supply in the market. And I was just noting, Matthew, you said that JP Morgan has committed around 1 trillion in the next 10 years. I hope a lot of this will help us bridge the gap in India per se. Right. So that's the kind of gap which is there. Now, obviously, all banks are hungry for credit growth. There were the good old days where our credit growth used to be 30%, but it's not there. So why are we not jumping the bandwagon? What is causing the challenge in terms of going into that? And if you see the problem, I'm not sure whether the graph is very clear for you. The annual contribution out of this 44 billion, most of it is actually coming from government programs and government viability gap funding for those things. Be it your green credit programs, be it your sovereign bonds which are getting funneled into these things. More than half is actually, more than 50% is actually coming from various government things. So still the public sector spending is still driving the transition finance. The private sector transition spending has to pick up, which is a big challenge. Now, why it is not picking up is one, we don't have a clear guidelines in terms of how do you underwrite this kind of projects, which is the biggest challenge when I speak to bankers like you. And I'll be happy to get some more feedback of what is the kind of challenges you're facing. But how do we underwrite? What is the risk entailed in it? We all know how to underwrite a normal coal-based power plant. Now, over a period of time, we have acquired the capabilities of underwriting a renewable energy power plants. But Is it the same case for an EV supply chain, the EV pipeline on cars, two-wheelers, etc.? Because that is where significant amount of investments are coming in, but it's more of equity, not of debt, right? And similarly, if on cement, we know how to underwrite a cement manufacturing entity, but if they start using renewable energy, green cement preparation norms, steel, how do we do that? We are a big agricultural economy. We still struggle on crop loans. Now, if somebody comes and says start financing sustainable farming, that's another big headache for us, right? So, what are the various sustainable financing for sustainable farming activities? Which one works well? What are the practices which actually produced a better yield? That kind of knowledge is something which is extremely needed, right? That's what banks would want in terms of how do I uplift my credit underwriting standards and build sector by sector what is the kind of transition pathways corporates are going to take, what are the technologies which work, doesn't work, or what is the kind of maturity which they're coming in, and those are the things which needs to be connected back into the underwriting capability. That is the biggest thing which I think banks are looking to build, and that's the sectoral knowledge people are building upon. So given you set the context on this, I'll just move on in terms of, sorry, this my bad. We put in a lot of text, but I'll just summarize some of these things. If I broadly break it down, what are the things which some of the banks in the global economy are doing, and what are the things which we in India can start adopting on a rapid pace? I'm not saying work has not started. There are examples in certain, even in public sector and private sector, some of the things have started off. First, in terms of the financing products. So be it sustainable linked loans as a significant portion of our advances portfolio. Green supply chain financing. Supply chain financing is something which is picked up very significantly in the private sector. And even some of the public sector banks have now started taking supply chain finance platforms for a co-lending kind of an approach. Can we start doing that? Use those capabilities to start creating green supply chain finance, which will have a significant impact for your anchor customers. Let's say Nestle is an anchor customer for a bank. We can actually help them to decarbonize their supply chain by baking in the green underwriting norms into the supply chain products which you're offering. Trade finance, again, a big significant thing. How can we start putting in those checks and balances on the trade finance related products? Then overall, in terms of blended finance, where there's a lot of capex required for various projects which have to be offtake, what is the kind of blended finance we can bring in where some of the viability comes from government or PSUs or from SIDBI or similar agencies, and private banks, both the public sector banks and private sector banks can start offering blended finance in this. And this needs a lot of dialogue between government and the banking players around it. What are the policies and procedures which we need to update? Obviously, the credit underwriting norms, your credit policy has to go up and imbibe a lot of the sectoral capabilities into this. We are great in terms of infra financing, a lot of, especially on the public sector side, there's significant skills which have been built over years. Now is the time to completely look at the next level of financing capabilities on the transition side of it. Then the whole host of data and technology which needs to be implemented in terms of once you start doing transition finance and you start qualifying it for green credits and other things, there'll be significant demand to you from a compliance perspective. We need to start looking at what is the use of proceeds for it. How are they actually being used for transition financing? And then the impact assessment. How is it actually impacting the decarbonization of that particular company? So to measure these things, there's a significant amount of data which banks would have to collect on their counterparties. And that is where significant investments need to come in from bank side in terms of building connectivity to various data providers and also creating your own internal models to start building these quantification processes. So I'll just take a pause here. I just wanted to keep it at a very high level, but these are certain things which needs a significant time and investment from banks to build this kind of a capabilities. I'll open it up for questions if there is any specific question.
I'm from Bank of Baroda.
Yes, sir.
My name is Dipankar. So just I like to ask one question. The transition finances require a huge amount of outflow of funds to the society. Do you feel that much commensurate cash flow will be generated by the company to repay those loans?
So
Until and unless there is a incentivized or there is a penalty for as a carbon tax or like that. So suppose a company has to pay higher carbon tax. To avoid that carbon tax, he can invest. And the cash flow whatever he will generate by investing,
so
he may repay that.
so it's a very important and a good question you asked, sir. The thing is, if you see in the next immediate 4 to 5 year term till probably 2030, a lot of the financing needs will come from market dynamics. It will not be coming from any regulatory push per se. So if I am a auto manufacturer, if I have to move to EV and diversify my business, what is the capex I need? That's when people will come in and people will start doing those things. For sectors like steel and others, the overall technology capability, once it is built out, obviously then you'll start getting viable financing proposals. So green hydrogen, while we talk a lot, it's not something here and now. Probably is 2-3 years down the line when it is a viable solution, and then you will start seeing the proposals. But we need to start also prioritizing in our books which are the sectors we would want to focus, where we see here and now kind of a demand, and start focusing on that. It's not that the all 170 billion will be spread across the sectors which we're talking. So primary bets are power, your automotive, which is where a significant transition is already happening. And if you see in power, the kind of the per unit cost of renewables have definitely come down significantly in the last 5 years. So if a company is not moving away into those segments, then their profitability is at stake, right? So those will be the near-term opportunities, and then the next longer-term opportunities will start coming in from sectors like green hydrogen and steel and so on and agriculture. Again, sustainable farming is a big thing. If in fact, for example, the UP government, they have started encouraging sustainable financing and using the carbon credits which are being generated out of the sustainable farming as an additional augmentation of the farmer income. So can that be scaled and that can be brought out? Those are the opportunity. I'm not saying that we need to jump on a bandwagon where we dump money. It has to make sense. Business.
It's a use in it.
Yes.
So ability is very much important.
Yeah.
Whether the additional cash flow will repay that, say burden or not.
Yeah.
That is financial burden. That is a very, very important question at this point.
So see, if you look 2 years back when rooftop solar panels are quite costly, but if you see from last 3 years till now, it has reduced drastically.
That's true.
But commensurate, if you see, has the rooftop solar kind of projects really taken up? Renewable projects have taken up, definitely. But rooftop solar, where we actually now see a viability happening.
Yes.
Panel costs have come down. The cost of electricity, as Ajay was mentioning, that has significantly come down. In some of the states, your renewable costs now 6-7 rupees per unit. Whereas in a state like Maharashtra, your normal electricity would be costing them 11-12 rupees. So that way also it is viable for the customer. Now we have a large segment of rooftop solar needs. We know that this project is viable, but still we are not funding. So that might be a very immediate opportunity that we can go ahead and try and do a funding.
So certain segments, it is a push. Certain sectors is a pull. For example,
the combination of both of them,
the corporate will be a pull from the corporates, but in, let's say, home loans, it's one of your favorite product. All the banks will have at least 30 to 40% of their retail portfolio in home loans. What is stopping us in giving a rooftop solar capability as a home top up? Because still we have at least on the public sector and the barring the top 3 private sector, there's significant exposure of home loans in tier 2 to tier 6 cities, right? and a lot of this will be independent houses. And now, as the electric vehicle offtake is happening in these cities, if somebody who has an electric vehicle and an independent house puts up a rooftop solar, it's a double advantage for the person.
The
A, they
issue
reduce.
is in the battery section. That is very costly. Rooftop solar has reduced, but the battery where we are
Which is 50% of the overall cost.
that is very
That is there.
One question comes here. Are we really doing justice to the carbon credits? Do you think we are capturing the market which we have got in our country? Are we doing enough for that? Like in UP, you said that government is doing something for carbon credits. I'm not hearing the same thing in other states.
So that is, and it's a very valid point you raise, sir. It is a function of the market availability and awareness, which has to go up significantly. And at least the fundamental enablers now the government has put in place in the last 1 year. After the Gazette, the overall carbon trading scheme, which Ministry of Environmental Affairs have rolled out, at least that is laying the foundation. Now it is up to the market participants to build a market around it. And Dan, if you want to mention anything what you were speaking to NSE, there would be the financial markets which needs to build out to build this. But to your answer, yes, it is
It's
not yet
There is
not
lot
yet
to be done.
recognized.
Yeah, lot to
And
be
the
done.
awareness has to be brought in.
Awareness. I
The
think
way
this is-
we trade in commodities,
I think the answer lies in this particular question. You said there is a lot of money required and there are gaps. The question is there should be a demand for renewable energy or lesser carbon emission from the public, from people, sitting here. Like when we are sitting here, again, you may take it otherwise, we should ask question, why do we have these plastic bottles here? So unless we are aware about the problem or we spread awareness amongst the masses, I think we'll not need that much of money which you are saying. It's okay, there's a calculation. I appreciate that. But my only observation is that awareness should come first.
exactly.
And second is carbon trading. Like we have enough of carbon, things which we are doing here, but we are not aware. We're not able to calculate. We are not able to get benefit of that. Otherwise, as of now, if I'm not wrong, I think 26% is coming from renewable source in our country from consumption.
Yeah.
That itself is a good number. So scenario is not that bad actually. And numbers, they may look bigger, but we have to start somewhere.
Yeah.
And it will definitely take us somewhere, we'll get
Definitely.
some good steps.
I just want to highlight the opportunities there. There's a lot of opportunities.
Oh,
It's
no.
not only the risk.
one thing, whatever the renewable energy is there, we can take it as a transition finance or we can take it as a green finance. I think most of them are green finance.
Most of it is
initially finance.
greenfield products are green finance, but if there is a company, let's say as a cement producer, and he is creating a captive in a substitution of grid electricity to captive unit, that will be transition finance.
Transition, yeah.
Because they have to reduce their own emissions.
Reduce.
Mukti will have some questions here.
Yes, sir.
Ajay, you'll be able to see it here in your
Yeah, sir.
iPad or-
No,
You
it's
want
not
to read?
connected, but I can read it.
Yeah.
Great slide. What?
Mukti, you can read.
Sure. Wanted to check on funding gap compared to NDC. Does this mean it's unlikely to meet NDC targets for India?
No, so this is not directly like to like linkage to NDC targets, the Panchamrit commitments of India. It has a slightly more higher utilization. What we showed as numbers is primarily for transitioning of primary sectors, which covers most of it, but there is an additional demand which will be needed to cover the full NDCs. There are certain estimates I'm happy to share with this group on that. But this is a subset of the overall target. And the second part of the question, is it unlikely to meet the NDC targets? I don't think so, because there is a significant interest from corporate world, from government, and all the stakeholders to meet what it is. And it is more, and everybody realizes it. If Mumbai air quality index is going to 300, then we all realize in Mumbai for sure. Right.
So the next question is contours of payback in transition finance, please.
No, that's a very broad question, but as I was mentioning to Dipankar sir, I think it will depend on the technology to technology within individual sectors, what is the kind of payback period we are looking at? Because if you see a renewable energy plant used to have a payback of more than 10 to 12 years, like a few years back. Now it has come down to 5 to 6 years. It is also a function of the maturity of the technology in each individual sector. And the maturity is growing very fast. That's something which we need to be aware.
Any other question?
No.
One question is that it is okay.
Yes.
So your slide showed that 56% of the financing is coming from the government budget. Approximately 24% is coming from the
Corporate
commercial
commercial
banks.
banks. Yeah.
So how do you see that overseas investments coming in the form of state PI in transition finance as well as in green finance? So is there any data available on that?
I don't have any. It's a very important, it's a pertinent question. Makes me thinking about it. I don't have any data of FDIs into climate finance or transition finance as it is. I need to come back with share anything.
Pull up some data points. There are certain data points about what kind of a
There are data points matter in
Yeah.
the OPEC country. They are
So
actively
mostly,
pushing that.
yeah, mostly if you see the investments that have come from outside, those have been primarily driven by the MDBs, the multilateral development banks. As such, from the foreign corporates, there is, see, at the end of the day, India needs to have, what we need to realize is that whenever an investor is kind of putting in that kind of a money, there will be certain requirements with respect to the use of proceeds and the impact generated. Because if you see today, if you pick up a report of BlackRock, whatever investments they make, they publish a very detailed report of how the proceeds are being used and what is the kind of impact generated from each and every project. So to an extent, it also depends upon the Indian corporates, how they are able to kind of put all of that data in so that they can at least give back the investors these two important data points, which today, the way things are, I think we really lack that kind of a rigor when it comes to collecting these kind of data points. And that's the same challenge why a lot of banks are also hesitant to fund these projects. Because at the end of the day, they need to see what are the kind of cash flows that are coming in. And that's why the data becomes a primary challenge for most corporates. So it's important. Maybe the projects are bankable, but it's also important to kind of showcase and measure.
That's what my primary question was. The earlier speaker, Matthew, I think he talked about moving from carbon intensity, carbon emission sort of a data point to carbon intensity data point. That's what at least JP Morgan is moving now. So carbon, if you don't measure carbon emission, how do you move into carbon intensity? That's the second question that I have. So I think what Dipankar sir has asked question which is very pertinent. If you do not measure something, how do you finance?
And that is where that's where the financed emissions comes into picture. Because if you see in the BRSR disclosures, we are still focused on scope 1 and 2 emissions. Scope 3 is now where banks have started to quantify their financed emissions, which will be 95%, at least 90 to 95% of your overall emissions. Your own operations will be this much. This financed emission will fill this room.
But BRSR now also talks about the entire value chain.
Yeah, that is where the entire financed emissions gets covered for banks. And that's where it is very important for now banks to start quantifying their finance. Because at least in the global arena, wherever the TCFD adoption has happened, or in the UK, HKMA, MAS jurisdictions, because of the regulatory interventions, people have started disclosing their scope 3 emissions. It's a very, very involved exercise. It's not just we did it once and we can go on. You need to now then have a repeatable process to quantify that on a yearly basis. Plus, whenever there's a new project proposal coming in, you should be able to quantify what could be the emissions which I will be financing in this context, which will go into your pricing decisions and various other aspects as well.
So here is also two questions. One, whether this quantification activity will be done by the financer or the company itself. If the company itself is doing the quantification, then it should be under audit.
So this is what
I think we are moving towards taxonomy basically, isn't it? And our next session is on that only. In the interest of time, although we have some questions, we'll come back in time. And Mukti, I think we'll come back to this question later because we have two more sessions. We have two more speakers. So I will now request Arman from EY.
Hello, everyone.
Yeah, we are able to hear you. Please go ahead.
Good. Can someone share the slides, please?
Yes.
Yeah, yes.
Okay, thank you. So yeah, basically my presentation will provide some update on what's happening in terms of taxonomies adoption and use in Asian countries as well as globally, and also provide some insights that we gained during a survey that we conducted last year together with IBA-ASIFMA among Asia Pacific region banks to understand to what extent these banks are using taxonomies, what are the challenges in adopting these taxonomies, and what kind of institutions basically are interested in taxonomies, and among a broad choice of taxonomies, which ones are the ones that banks in Asia Pacific are focused the most. So if you go to the following slides, please. So yeah, I already talked about the subjects. Let's move on, please. Yeah, so basically you can see here a list of a number of taxonomies in Asia Pacific and also in the European Union. It's probably needless to say that the taxonomy that the EU adopted and enforced more than 2 years ago now, it's the most comprehensive taxonomy, and many of the taxonomies that were developed and are still being developed in different countries, they look at the EU taxonomy to gain more insights from what has been done there and replicate some of the elements. But that doesn't mean that whatever we see in Asia Pacific countries are exactly the same. No, this is not the case, because the EU taxonomy is by far the most detailed, technically tilted taxonomy that we have globally. Now, you can see the taxonomies that are highlighted in yellow. These are the ones in Asia Pacific region and also the EU that have already been developed and they are ready for use. Any ones that are in turquoise color are either in the consultation phase, different levels of consultations, or are still being developed. And in terms of the degree of development, again, as I mentioned, the EU taxonomy, at least the environmental part of the sustainability taxonomy, it is already being used. China is the most commonly used one, is the China's green bonds catalog that is used for Chinese issuers to issue green bonds against this catalog. Philippines has its own taxonomy. Malaysia has two taxonomies actually. One is predominantly used by banks, the other for
Arman, we stopped hearing you, if you still hear us.
Mish, any issue with our? It's correct. Arman, are you with us?
I'm with you, but the slide does not change.
Slide is there.
It's okay.
Yeah, the
Please
next
go
one.
ahead.
Next one, please. Yeah. All right. So this slide and the following one, they show basically the key and in Asia Pacific region, and also the similarities that this type have in terms of their composition their focus areas.
Having some issue, we are not able to hear you.
I'm sorry, can you hear me?
Yeah, we are able to hear you now.
I just received a message that you can't hear me. That's why. Anyway, so EU taxonomy addresses 6 environmental objectives, with the most prominent ones being around climate change, mitigation and adaptation, but they also cover biodiversity, circular economy, and so on and so forth. Now, if you look at the remaining taxonomies, and here we have listed ASEAN taxonomy, the Singapore one, Malaysian taxonomies, and the Philippines, you can see that climate change, mitigation, and adaptation are in all, taxonomies. So these are predominant objectives that all taxonomies try to address, and that's understandable because climate change mitigation, first and foremost, is the #1 priority when it comes to sustainability. So climate change mitigation, adaptation, all taxonomies aim to cover that. But there is also the topic of biodiversity, which also tends to be a very important focus area for the remaining taxonomies, as this topic, is moving to the top of the agenda for sustainability. Now, in terms of the general approach, how taxonomies have been built, the EU taxonomy, as I mentioned, is highly technical. It has the key part, which talks about the principles of the taxonomy, and it has this technical part, which is technical screening criteria, whereby you've got a list of different sectors of industries and different activities within each sector. And there are technical criteria with their formulas and KPIs that should be met in order for that specific taxonomy be recognized as, significantly contributing to the environmental objective in question. Similar approach is being applied to many other taxonomies, except for the Malaysian taxonomies, which is broadly principle-based. Thereby, they provide the principles as to what is believed to be sustainable activity, and the details are not that deep. But the remaining taxonomy is similar to the EU one, not to the same depth, but still they provide further technical details so that the users and preparers of information on these taxonomies, they can apply that. Now, that provides more transparency, but it also provides a lot of complexity. And we'll talk about it a bit later when we cover the findings of the survey we conducted. Can we move to the next slide, please? And here we are basically showing a number of other key features of these taxonomies and what kind of similarities we have. The color coding is one, very commonly considered approach that many taxonomies take into account. It's easy to understand and it's easy to use, whereby you apply 3 or 4 colors, thereby identifying based on the colors which activities are the most green, which ones are kind of in between or supporting transition activities, and which ones are not sustainable ones. So this approach is being used by many taxonomies. It's not being used in the European taxonomies, as I explained. There are more detailed technical criteria for that. But in other jurisdictions where they have taxonomies developed or taxonomies are under preparation, this is being used, and in some ways it is going to be a simplifying factor for using those taxonomies. One important element which the taxonomies also address is what is the impact of certain economic activities on other environmental objectives and on social matters. So this is something that the EU taxonomy is addressing. So under that taxonomy, they have a concept which is called no significant harm, which means that if you are talking about some activity which is meant to support climate change mitigation, you should ensure that all the other 5 environmental objectives under the taxonomy are not negatively affected by that activity. And at the same time, you want to make sure that a certain set of social factors, they are not also being affected. So that is called minimum social safeguards. There are 4 groups of social considerations that you have to screen before you can consider that certain economic activity is eligible under the EU taxonomy. Now, do not significant harm concept is applied by other taxonomies as well. They have different terminology, obviously, but that concept is there, and that's logical. Because if you are doing some activity which creates certain environmentally positive outcome, it is likely that it can have some side effects, and those side effects could be negative in certain cases, and therefore you want to make sure that whenever those side effects are substantial, such activity is not considered as environmentally sustainable, and as such, green financing is not moving there, or at least if there's financing of that activity, it is not called sustainable or green finance eligible activity. Now, finally, on the reporting side, what kind of reporting is prepared and what's the overall use of the taxonomy? Generally speaking, there are 2 use cases for taxonomy. The first one is to report the overall sustainability of a company's activity. So if you have a bank, you want to share which part of your activities in terms of assets, loan book, or revenues are aligned with some environmentally positive outcomes. Or if you are offering certain financial products, you want to use taxonomy to classify and label those financial products. So these are 2 general use cases for taxonomies. That's what is applied in the EU taxonomy. So they're using the taxonomy as the input, the source of information for 2 of the key sustainability regulations in Europe, which is the non-financial reporting directive, and the second one is the Sustainable Finance Reporting Directive, or SFDR. So these are the use cases in Europe. There is no mandatory taxonomy aligned reporting in most other countries. And therefore, those entities, financial institutions or others, which use taxonomies, they either use it because they have operations in other countries, Europe or elsewhere, where they are mandated to use taxonomy to report their worldwide operations and activities, or because they have certain financial instruments and they want to label them by using taxonomies. So broadly speaking, these are the use cases outside of the EU where we can see taxonomy use, and we can provide more of that in the next few slides when we cover our findings on from the survey we conducted. Can we move on, please? Next one. So as I said, we conducted last year a survey together with ASIFMA. We reached out to a number of members of ASIFMA in Asia Pacific region. We received responses from 13 banking institutions. 11 of them provided full answers to the questions, 2 provided partial answers. And most of the questions were about, are you using taxonomy? Why are you using? What kind of challenges do you have? What taxonomies do you use? And also trying to understand the business model of these institutions and the rationale for them to use any taxonomy. So on this slide, you can see some basic information that we collected. in relation to the headquarters of these of the respondents. So in this case, most of the respondents, they were inbound or international firms operating in Asia Pacific region, namely US headquartered banks there are 4 of them out of 13, UK headquartered 3 of them, and EU headquartered were 2 of the financial institutions. Now 8 out of 11 respondents, they said that they have started to use a taxonomy. So that's an important findings, that majority, or in this case 73%, have already started to use the taxonomy. Very important finding was also the fact that majority of those firms that have already started to use the taxonomy, they say that they're using the EU taxonomy, and that you can also see depicted on this slide. And there is no surprise here, because again, banks tend to use taxonomies when they really need to use that, which is driven by regulatory reasons. Some respondents also talked about other taxonomies, such as climate bond initiatives, green taxonomy, their local taxonomies, if they have been in force, or some internal taxonomies that firms have built to cover their worldwide operations. Let's go to the next slide, please. So what we have is that 64% of all respondents indicated that they have chosen taxonomy because of regulatory disclosure purposes, and 36% mentioned product labeling. We also learned that most of the stakeholders within banks that take care of the taxonomy related activities, they are in the risk and compliance functions, which again speaks about the fact that for the time being, taxonomy is being used just because it's a mandatory exercise and it is required for reporting purposes. When it comes to challenges in implementing taxonomies, 2 areas were of specific importance. First one is about data, both the quality data and its availability. And second one was the lack of clarity for using taxonomy. And again, this is also coming as not a surprise, because since many of the users have been using the EU taxonomy, and it is a very technical one, it is understandable that for the time being, it's a new document, it's a very technical document, and in many cases, to interpret activities and some technical parameters behind certain industries' activities are going to be a challenge, and obviously it's going to take some time to learn and more effectively implement those taxonomies. Now, the remaining slides, if we move on, please. The remaining slides basically show some of the answers that we received to our questions. And again, they highlight the type of companies, the headquarters. You can see here that the largest part of the respondents were based in Singapore, Hong Kong, mainland China. So those jurisdictions and countries with significant concentration of international banks. And if we move on, please, just I will highlight a couple of answers, and it would make sense to take questions if you have. So in terms of the focus of those financial institutions, you can see that they are predominantly wholesale institutions with heavy focus on investment banking, capital market activities, and commercial banking. And next one, please. This, yeah, basically I already talked about it. Have you used the taxonomy? And again, majority of them said no. They said yes. And the following questions and answers speak about what I already covered, which is that the EU taxonomy has been the predominant one which has been used. And again, the main reason is that many of the preparers of this information were international firms with significant EU operations, and therefore they had to prepare information under the taxonomy, and therefore EU taxonomy remained as the main one used by these institutions. I think it makes sense to stop here and take questions in the interest of time.
Thank you, Aaron.
Just in the chat box, chat box. No questions.
I had a question. I just wanted to know, across all these taxonomies, since they also have a social element in it, how are defense transactions really dealt with across taxonomies? So banks would also be financing a bit of defense sector, right? So how are these particular defense transactions treated under the various taxonomies? Or is there any guidance at all in the taxonomies on the sector?
Yeah, that's a good question. Again, among the main taxonomies that I use, the EU taxonomy is one that has clearly identified social safeguards. One of the social safeguards is human rights, including workforce, the right of labor, workforce. And if you talk about defense sector, that question comes into force because the use of the product of that sector obviously is affecting human life and human rights. And this is something that for the time being hasn't been dealt fully. And now with these several wars ongoing, this is something that both governments and also financial institutions are contemplating more and more. To what extent they should take into account necessary financing of defense sectors whilst accommodating sustainability and social aspects that come with sustainable investment. Again, there is no full response here, and EU is the only jurisdiction with taxonomy that has it in place. But for the time being, obviously, defense is not considered as a sustainable sector, and therefore, it is if you are financing defense sector, obviously, both from environmental and social perspective, it is not a sustainable activity. Okay.
Sir, one question posted on the chat box: why there is no global standard taxonomy which can be referred for local ones?
That's another great question. Hopefully someday we'll have, but similar to many other, pieces of sustainability initiatives, this field of play is very fragmented. One reason is that there hasn't been set up a global body that could take ownership for that. So, for example, we have IOSCO, who basically took ownership for climate-related disclosures, and they developed TCFD, which became a global baseline. For taxonomies, we didn't have such an initiative. That could be one reason. Another reason is that many jurisdictions, they have their own sustainability and economic agenda, and they want to make sure that these taxonomy activities, they're all aligned with their national interests. And therefore, you can't use a global taxonomy, which is going to always be suitable for all of your national interests. So just think about net zero, right? The whole purpose of taxonomy is to identify activities that are going to provide environmentally positive outcomes aligned with 2050 net zero. Well, 2050 is not the goal that all countries have adopted, and therefore one activity can be aligned from that perspective in one country, and in another country it can't be, because their timelines are different. And also different countries have different, setups of economies, with some countries having more focus on one area, for example, power generation or mining. Another country has different, and so therefore their priorities are also different. And having a single, global taxonomy will not meet the expectations of all countries, especially the large ones that want to have more control over what is considered as sustainable activity within their economies. Okay.
Oh, no.
I have one question. When we say substantial contribution to one of the objectives, how the substantial word has been dealt across different taxonomies?
Sorry, I didn't get the last part.
How the substantial contribution, the amount of carbon emissions reduced, has been dealt across different taxonomies. Yeah, quantifying of the substantial contribution.
Yeah, so again, that refers to the technical features, how you what kind of technical features you can apply to make sure that that specific activity significantly contributes to environmental sustainability. So if you are talking about net zero, that's about climate change mitigation. So under the EU taxonomy, you have specific, thresholds. So for example, think about, battery manufacturing, right? So battery manufacturing is an important part of climate transition. You can use battery for electric vehicles or for using as a source of accumulated energy. So depending on certain technical parameters, you can classify battery manufacturing as substantially contributing, or which means that they are eligible as a green activity or not. And that refers to certain activities that are associated with sourcing all the materials for battery manufacturing, that environmental elements associated with that, and also the social elements, because many of the materials are sourced from places where significant social controversies can be present. And therefore, these, technical criteria are applied in order to determine which specific activity could be considered as aligned with climate change mitigation, i.e. net zero purpose. Okay.
Thank you.
Any question here, or we should come to the next session? So thank you, Armin. Thank you very much.
Thank
I
you.
will now next speaker, Catherine Watman.
Yes, thank you. Hi, everyone. Let's see if I can actually share my own slides. Can you all see the slides?
We are not able to see. If you don't mind, we can share from our end.
Sure, then maybe that's easier if you guys go ahead. Okay, great. Thank you. Cool. Yeah, so I'm aware of time, so I might be rushing through some of these slides, but feel free, of course, to just interrupt me if you have any questions. Yeah, I think as you know, my name is Catherine Workman. I'm an associate director in the climate research team at Sustainable Fitch. I myself am actually based in London, but I do have loads of colleagues who are based in Singapore and Hong Kong, among other locations. It's been really great to hear all these presentations and discussions today up to this point. And actually, we've already I think, touched on quite a few of the issues that I will be discussing throughout the presentation. So yeah, I hope I can still add something new and interesting that's worth discussing. So what I'm going to focus on in this presentation is kind of two somewhat separate issues. So first, I'm going to talk a little bit about some of the main climate-related disclosure trends that we are seeing across the world, to give you just a good sense of what is going on in other regions and industries. And then I'm going to talk in a bit more specific sense about the issue of corporate transition plans and how to assess the strength of these kinds of plans. Yeah, so let's dive straight into disclosure regulations and trends. If you could move, I think for 2 slides probably. Yeah, next one. Yeah, there we go. So this is really just to quickly, oh no, one back. Sorry, you went too fast. The slide with the map, with the world map. Yeah, there you go. So this is really just to briefly set the scene and give a bit of an overall view of the trends that we are seeing across the world. Of course, as you can see on this map, and I think everyone in this session is aware, a lot of countries across the world have in place policies or laws that ensure that countries achieve some sort of net zero climate related target in the coming decades. And even more countries have announced similar plans and pledges to move in that direction. And I think actually at this point, it's well over 90% of global GDP and over 80% of the world's population that have really been covered by some sort of net zero law or policy or pledge. And we at Sustainable Fitch, we just really think that this trend shows how the world's governments are really responding to climate change and how new laws and policies can disrupt industries, they can impact markets and change consumer behavior across the world and really present that transition risks to companies and investors. And of course, one specific way that governments are responding to climate risk is the mandating or regulating of climate-related disclosures, which brings us to the next slide. In many jurisdictions, we see kind of they are individually moving towards developing their own disclosure regimes, many of them mandatory by now. And here on the slide, you can just see a bit of an overview of some of the important ones. And you can just see how regulations are already affecting or are already effective in some of the major jurisdictions and markets and under development in several more. And maybe just to highlight some that we've already heard of today, obviously in the EU, we have the Corporate Sustainability Reporting Directive, the CSRD, which is a sustainability disclosure regulation for companies that are listed in the EU or of a certain size operating in the EU. And the CSRD regulations are being phased in over the coming years, and they will impact all large listed companies operating in the EU. And we expect there to be really quite a considerable knock-on effect on smaller companies or companies based outside the EU, which are part of the value chains of these EU-based companies, just because of changing stakeholder expectations that this will create. There are other regulation regimes and developments worth highlighting outside the EU as well, of course. There's a lot happening in the APAC region. For example, we see climate-related corporate disclosures are quite quickly becoming mandatory. I think we already heard it earlier today. Japan being one of the first ones moving on this and making things mandatory, and more countries are following suit lately, across the world, including, I think Australia is one of the more recent examples as well, announcing their development of corporate climate disclosure regulation that's likely going to come into force next year. So really just across the world, across the board, a lot of countries moving on this and impacting pretty much every sector and every industry. Next slide, please. So now that we've seen how climate disclosure is developing across the world, I want to just dive a bit deeper into one issue area, which we think is really particularly important. And we've already touched on it a little bit earlier today, because it's so important to market participants. when it comes to climate disclosure, and that is the disclosure of Scope 3 emissions, so the emissions that occur in a company's value chain. And Scope 3 emission disclosure is important because, among other things, it is a really good proxy for investors to understand a company's exposure to climate risk, and also allows to have a really honest conversation about the true impact of doing business. And while mandatory Scope 3 emissions disclosure still remains an exception, we do see a clear trend, especially in voluntary frameworks and guidelines, towards Scope 3 disclosure. And in addition, we also think that stakeholder pressure will have quite a significant impact on companies to disclose their Scope 3 emissions. We've actually used Sustainable Fitch ESG ratings data to see, and we found that banks are most likely currently to disclose their Scope 3 emissions, so their financed emissions. So, emissions that come from their portfolio companies, as you know. And it's really, with this growing number of financial institutions setting their own net zero targets or portfolio decarbonization targets, we think that especially pressure from investors will grow to move companies towards disclosing their Scope 3 emissions, even in the absence of any kind of mandatory disclosure. And we think that corporates and investors will quite likely have to invest in building capacity to measure and report the necessary data, and to overcome challenges with data availability, comparability, and credibility as well. Next slide, please. And we've already mentioned it as well today, the ISSB. I think most of you are aware of this really kind of major milestone that has happened earlier this year towards standardizing global sustainability reporting with the ISSB that published its really long-awaited standards for sustainability-related financial reporting. This initiative has united several well-known sustainability reporting frameworks and standards, such as the Sustainability Accounting Standards Board, or SASB, and others under kind of like one umbrella. And it also very much builds on and has kind of taken over from the Task Force for Climate-Related Financial Disclosures, the TCFD. Now, investors and companies have been really operating in kind of an environment where it's been really difficult to compare and contrast information on sustainability and climate. And there was this, alphabet soup. Obviously, I just mentioned it, right? The SASB, TCFD, and others. And most of it voluntary, not really comprehensive. And there was just also a lack of complete global buy-in. And of course, investors need a baseline of information they can use to make their decisions. And so the aim of the ISSB is to really finally deliver that baseline. And we believe it will be a significant improvement to really help investors as well as corporates that have been struggling with the quality and availability and comparability of sustainability and especially climate-related data. And we think that the uptake and the adoption of the ISSB standards will be really strong. I mean, we've already seen it actually across several jurisdictions, including the UK, Australia, Japan, Canada, I think Singapore, Nigeria, Chile, and others announcing that they are considering incorporating ISSB into their own reporting regimes. And of course, IOSCO as well has endorsed the ISSB. So that's been a really important development, we think. And next slide, please. Yeah, this is really just to give you kind of a brief outlook. New ESG and climate-related regulation is changing really fast across the world, and it's really worth keeping an eye out on these kinds of developments. And we actually have a tool, the ESG Regulations and Reporting Standards Trackers, that tracks these kinds of developments. It's free, available on our website. So if you find that useful, do go and check it out. Yeah, but just rushing through things a bit, apologies. I just have I'm very aware of time. So maybe moving on to the next section, next slide, please. Because now that we've had a bit of a look at disclosure and regulations, let's move on to transition plans, which are becoming more and more important, as you know, part of these kinds of disclosures and regulations as well that we've seen before, kind of setting expectations of companies to develop these plans. And I think in the interest of time, let's skip this slide and the next one as well. And next one. Yes, thank you. Because I think we've already discussed quite a bit of what was on these previous slides. I'm keen to leave some time for questions as well, if possible. So with the whole world economy and global capital flows kind of being shifted towards low carbon pathways, the whole transition towards a low carbon future, companies really need to develop strategies to align their business with these pathways and develop strategies to remain profitable in this new low carbon world in the long term. And this is really where transition plans come in, because climate change and the transition to a low carbon future really present significant risks to companies, and they will need to develop transition plans to mitigate and manage those risks. And at the same time, transition plans are not only important for companies, they are also really key tools for investors and lenders. Because through transition plans, investors can assess whether a company has identified climate-related risks and is transitioning its business to manage and mitigate those risks, and also, of course, seize opportunities. And finally, corporate transition plans also really help investors who have themselves set portfolio decarbonization targets to make sure that they achieve those targets. Now, unfortunately, even though transition plans are so important and useful to both corporates and investors, a recent review by the CDP has actually shown that only very few companies disclose credible and robust transition plans. But we very much expect this to change quite significantly in the next few years. Next slide, please. So now I just want to talk to you about how investors actually can assess the strength of a company's transition plan. And of course, this is a topic that in and of itself, we could fill an entire webinar like this. So again, in the interest of time, I just want to focus on some of the key points, specifically the kind of the key elements that you see here on the slide. So let me start with targets, specifically greenhouse gas emission reduction targets. So since the aim of a transition plan is ultimately to align the company's business activity with the Paris Agreement, lowering emissions is fundamental to a robust transition plan. However, while there has been a real proliferation of emissions reduction targets across many different industries in recent years, not all targets are created equally, and some are a bit more credible than others. And it is really important that a company has absolute emissions reduction targets, which really means it aims to reduce the absolute amount of emissions that it produces. Many companies only have intensity targets, which aim to lower the emissions intensity or a company's business activity, for example, emissions per unit produced or emissions per revenue made. And while this can be a really good indicator for the efficiency of a company, especially when compared among its peers, lower emissions intensity does not necessarily lead to lower total emissions if the company increases the underlying economic activity. And another important indicator for whether a company's targets are robust is whether they cover all material emissions throughout the company's value chain. So this means emissions reduction targets should cover emissions from the company's own operations, so Scope 1 emissions and Scope 2 emissions, but of course, we've already heard it earlier today, the so-called Scope 3 emissions. And finally, a transition plan is only credible if the company has short-term or interim targets. So if a company only has a long-term 2050 emissions reduction targets, it can be quite difficult to see how they will actually get there, especially since current management will not really be held accountable to achieve the targets or make changes to the business to set the company on the right path through transition. So this, of course, yeah, it's a really important point around kind of accountability and holding current management accountable for these kinds of actions. And ultimately, credible targets, of course, need to be based on kind of complete and comprehensive greenhouse gas emissions reporting, something that's increasingly required by regulations across the world. Now, governance is another important principle based on which the credibility of a transition plan can be assessed. For example, if there's no measures in place to hold current management to account for implementing the transition plan, such as KPIs tied to executive remuneration, the transition plan will quite likely stand on shaky ground. And moving on to just the next indicator, I think really important as well, is scenario analysis. So a credible transition plan should be underpinned by robust scenario analysis using scenarios that describe pathways which really actually align with the Paris Agreement, and ideally actually net zero pathways. So this really allows companies to then identify and assess climate and transition related risks and opportunities. And based on the scenario analysis and the identified risks and opportunities, a company will really need to integrate its transition plan into its financial planning and investment decision making. So, CapEx and OpEx allocation and an understanding of future revenue sources are really key in this regard. And finally, a credible transition plan should not only look inward, but also outward. So a company should have a plan on how to engage with its key stakeholders on climate risk and transition, including its value chain, contractors, customers, but also quite importantly as policymakers and governments. So these are really just a few of the key points to consider when assessing the credibility of a company's transition plan. But ultimately, progress will really need to be measured and demonstrated over several years to be sure whether a company is really transitioning and keeping up with the initial transition plan. So I know this was just a very quick overview, but I do hope it's been helpful in strengthening your understanding of this. I do have some more slides, but I do see we're at time, so let me stop here and see whether there's time still to take questions or just handing back to Diana.
Thank you, Catherine. I think we are reached the end of our time, perhaps, but
if Catherine is available and some people have some questions, you can have a look at.
Yeah, I'm happy to take question.
Yeah.
Should we read out the question?
Yeah, please.
So the question is, are the rating agencies exploring options to merge ESG rating with credit rating versus current standalone credit rating and ESG rating?
I think that's a question that is a bit above my pay grade. I know obviously at Sustainable Fitch, at least, we are a completely separate entity from Fitch Ratings. So I know that Fitch Ratings does have ESG, trying to remember now what they call them. They do kind of include ESG considerations into their credit ratings, but that is completely separate from the ESG ratings and scores that Sustainable Fitch develops. And I think quite important difference there as well is, I think, again, Fitch Ratings, separate entity from Sustainable Fitch, more kind of looking at how ESG, ESG criteria might impact the credit rating of a rated entity, whereas the ESG ratings that Sustainable Fitch actually offers more looks at ESG impact. So it more looks at the impact that an entity or an issuer has on specific ESG topics. So those are, I think, quite separate issues and developed by quite separate entities.
Okay, so there is a last question. Okay, Catherine, there is a last question. Do you have a sense of transition plans among Indian corporates?
I have to be honest, I don't know. I myself am more focused on Europe and North American companies, but I'm more than happy to connect you to my colleagues in Singapore or Hong Kong who might be able to talk more to that topic.
Okay. There's one more question.
Yeah.
Okay, so Catherine, again, we've just received a question. One of the hindrances to transition planning is scenario analysis. What are some of the factors you would look in creating scenarios, or any frameworks you suggest?
Yes, that's a really big question. I think so. What we see a lot of, we ourselves actually use the inevitable policy response scenarios from the UNPRI developed, which we find quite useful because it looks at a lot of different sectors and more in a way where it really looks at what is happening right now in terms of policy making and how might that impact specific key value drivers that we find really useful. But then obviously at the same time, there's also other really useful scenarios from the NGFS, for example, the Network for Greening the Financial System, that we found quite useful. I'm happy to share a paper that me and my team have actually written on this topic around the use of scenario analysis and kind of the different use cases and the different kinds of scenarios there are and what users might want to consider and some of the drawbacks as well, because there is, yeah, we can talk about this for hours and hours. So it might almost be easier if I just share that paper with you. That might be quite interesting.
Indian context, some of these scenarios so because the India's legacy commitments that we see is kind of different from the scenarios that you would see for the IEA or for IBA. So we might need a bit of a tuning or a dampening of the scenarios, and for certain sectors, like for example, steel, power, trajectory that India will follow will be a bit different from the advanced economies. So those considerations have been brought in when we are developing the scenarios for the Indian corporates welcome the transition.
Transiting from the outro some sectors, also the longer transition plan that is European in the.
So there will be a dampening of the scenario trajectory that you see. What is stopping in 2050 for them? For India, it might have to step to 2070. So there would be a dampening effect. Also, the trajectories might not be exactly similar to how it is outside. We might have to see a more of what should I say,
peak and then coming
peak, which happens, say, somewhere in 2040, 2045, whereas in the advanced economy, that is happening somewhere at 2050. And then after, it's a declining trend. So for us, it has to be till 2040, 2045, followed by a decline till 2070. So that's how we do it.
For IBA, so there are the scenarios like EPS or steps. So they also take into the regional considerations into that. Even for that matter, NGFS also takes into regional considerations.
So, like for example, NGFS now has come up with those 5 short-term scenarios. For example, like if we are planning for something for an immediate business planning objective, some of those scenarios can be picked up and contextualized for them. Those have to be, so it can be a lift, a calibration followed by a kind of usage for it.
I think you could cover most of the questions. If there any question was left out, we can.
One question has just come up.
One last question.
Okay. How serious the disclosures be taken in view of many instances of greenwashing? How to cross-check it? How far third-party reviews will be effective?
Yeah, really good question. I think greenwashing certainly is a huge issue, and I think the good thing about the developments we've seen around, especially with the ISSB, kind of creating that global baseline and just overall developments of more agreement around how to define certain terms, how to disclose and measure certain things, will definitely make it more difficult to greenwash and will make it more easier for investors as well to spot greenwashing. So I think that's also something that with time will just improve, but it's definitely something that needs to be very much, you know, in top of mind of people. In terms of third-party reviews, I'm not sure if I fully understand that part of the question, but I think there are certainly, you know, moves in certain regulations, certain jurisdictions to have at least some of the data audited. And this will, of course, also improve things. I think once we move kind of towards almost move into the realm of financial disclosure with the auditing, again, will make certainly some of the data at least more reliable and more comparable as well. But I think there's also some data that will be very, very challenging to be audited. So I think that's something where, again, a lot of, you know, capacity building, a lot of upskilling will need to happen in the coming years.
With this, questions are all addressed. With this, friends, we come to end of this webinar, and time to say a big thanks to ASIFMA, represented by Naina Parusheva, and these speakers, Matthew Chan, Arman, Catherine Wartman, and Mr. Ajay, sitting with us here in our hall. And to all the participants, all senior bankers who have participated and made this discussion very active and live. So once again, thanks to all of you for participation. With this, we'll conclude it here.
Fantastic. Thank you all. Thank you.
Thank you. Thank you.